Welcome back to our University of Missouri Extension leasing series designed to help farmers and property owners with leasing arrangements. I'm Julie Harker, news strategist with Kapner Extension. With me this evening for our fifth program is David Reinbott, who will talk about crop share leasing. A reminder, we will take questions from you as we have in previous programs. We need you to type them into the chat box at the bottom of your screen, and they'll be answered at the end. David, tell us a little bit more about your role with the university.
My name is David Reinbott. I'm a field specialist in agricultural business with the University of Missouri Extension in the southeast region of Missouri. My program responsibility is row crop economics and marketing, and I've worked with the University of Missouri Extension for almost 39 years.
That's a good little while there. In this leasing seminar series, we just finished discussing fixed cash leases last week. Today, we're going to discuss share leases. What are the primary differences between cash leases and share leases?
In a cash lease, the tenant pays a fixed dollar amount in rent to the landowner, either on a per acre or whole farm basis for renting the farm. And the tenant is also responsible for all the price and production risk. Now, with a crop share lease, price and production risk are shared between the tenant and the landowner. Also, some of the yield and revenue enhancing variable inputs, such as fertilizer, are also shared between the tenant and landowner.
In your experience, David, why do farmers choose share leases?
In my time with Extension, I've seen maybe three primary reasons. Number one, I call it simply the tradition or past history of renting the farm. We see the same tenant or the same tenant's family may have rented the farm from the landowner, the landowner's family, for many years or for many generations, and they have worked together real well, had good working relationships, they trust each other, and they're just going to continue it just as it is. I found another reason is the idea of sharing of risk and rewards in high and low revenue years. From a landowner's perspective, in a high revenue year with good yields, good prices, or both, the landowner can earn higher crop rent than he would receive in a fixed cash rent. From a tenant's perspective, in a low revenue year where yields are down, prices are down, costs are up, or a combination of factors, the tenant is not locked into that high cash rent payment. And thirdly, it can help in planning when you're looking at a long-term lease for maybe 7 to 10 years. It's impossible to know what crop prices will be in that many years out. But the tenant does not want to be locked into a high cash rent with all the price and cost uncertainty. On the other hand, the landowner does not want to feel like he got sort of left money on the table if prices or revenues continue to go higher.
All right, very good. Well, let's all look at this video that is introducing share leases.
Share leases make up about 20% of farmland leases in Missouri. Share leases have become less common over time, but are still important to understand. They remain a very viable leasing option to help meet the objectives of both property owner and tenant. A crop share lease is one where the landowner and the tenant split the crop produced in proportion to their share of contributed expenses. The landowner typically provides all the costs associated with land and is credited a return or rental rate on the land. The tenant frequently provides the labor, field equipment, and fuel for the equipment. The tenant and landowner either split remaining input expenses, or one party assumes responsibility for those other expenses. Who covers what expenses sometimes becomes a point of negotiation in the lease. Share leases share both the risk and the reward of crop production. Crop price and yield risks are shared between landowner and tenant. Share leases can be an equitable way to lease farmland. They present benefits and challenges. Share leases benefit tenants by requiring less capital than a cash lease. Tenants with share leases do not make cash rental payments and are not responsible for the portion of other input expenses paid by the landowner. The landowner must have sufficient cash to cover shared input expenses. She also needs to be comfortable reviewing input expenses she will pay. She should be able to understand any invoices she receives. Often the landowner allows the tenant to sell her share of the crops. But some landowners choose to market their own share. If the landowner markets her share, she needs to work with the tenant to agree upon where and when her share of the harvest is to be delivered. Crop share agreements require greater attention to detail than do cash leases. For example, the tenant normally purchases and applies crop inputs. Records and invoices need to be saved and shared with landowners so that the landowner can pay their share. Good communication between landlord and tenant fosters a good crop share leasing relationship. Opportunities for disagreement arise if the landowner gets a bill for an expense that is higher than expected. Tenants can prepare the landowner for higher expenses by communicating increasing input prices before sending the invoice. Unexpected expenses can also cause conflict. For example, a crop harvested at a higher moisture content may require more drying and higher fuel costs. The decision of when to harvest was made by the tenant, but the expense of drying may be shared by both. How to share unexpected expenses should be discussed prior to the lease agreement. In some share leases, the landowner reimburses the tenant for inputs. This can create a financial strain as the tenant must float the expense until the landowner pays. Other share leases have the landowner directly billed for crop inputs. A share lease might be considered by some input providers as a partnership, leaving both parties of the lease subject to each other's liability. A good share lease should clearly state that it is not to be considered a partnership. Share leases also impact government program participation. In a cash lease, all government payments are to the tenant. With crop share leases, the landlord is eligible for government program payments. Share leases may impact taxable income in several ways. Landowners may or may not be considered a material participant in the business. If they are material participants, they pay self-employment tax on net income and may have reduced Social Security benefits. Share leases enable landowners to manage taxes by timing when expenses are paid and crops are sold. Most farmers purchase government-subsidized multi-peril crop insurance. With a crop share agreement, the landlord and tenant typically purchase separate crop insurance policies for their share of the production. They can use different insurance companies and purchase different coverage levels. The risk management agency that oversees crop insurance prefers that crop share agreements be written so there is a document verifying insurable interest in the crop. Consult a crop insurance salesperson for other insurance implications of crop share leases. Written leases are always a good practice. Putting it in writing is even more necessary with crop share leases because so many decisions need to be clarified before production begins.
All right. One of the chief characteristics of a share lease that I noticed is that the landowner shares the input expenses of crop production. So are all the variable input expenses split equally between the tenant and the landowner?
No, not all expenses are split. Only those which the landowner and tenant have agreed to ahead of time are split or shared. Sometimes expenses are all equally split, but many times they're not. In most crop rents, which I'm familiar with, the tenant landowner will split the fertilizer expense because it is a yield enhancing input. Now, sometimes fungicides, insecticides are also split, but the splitting of these variable inputs costs can be a point of negotiation in the lease.
So how should the tenant and landowner handle unexpected expenses like drying high moisture corn?
You know, there's always going to be unexpected costs when it comes to row crop farming. These potential unexpected costs need to be identified from past history, worked out ahead of time if possible, and put in writing. For example, here in Southeast Missouri, there's always that risk during corn harvest in August and September of receiving high winds, excessive rainfall from the remnants of hurricanes that enter the Gulf of Mexico. This results in the tenant attempting to harvest their corn crops sooner than normal at higher moisture levels. Therefore, some tenants will charge a landowner maybe 10 to 15 cents a bushel to dry their share of the corn, depending upon the moisture. And this also becomes a negotiation point to lease the farm.
Another characteristic of share leases that I noticed is that the landowner gets a share of the crop rather than a cash rental payment. Should the landowners expect the tenants to market their share of the crops?
In general, the tenants will market the crops for the landowner if they want them to. But I've also seen where the landowners prefer to market their share of their crops themselves. Many times, these are landowners who follow the markets very closely, or landowners who have recently retired from farming, and they feel they still have a good grasp on the markets. But if the landowner does market his or her share, they need to maintain good communication with the tenant on the elevators they're going to use, make sure they get the right cash contracts and sales, and the delivery months of the grain.
So do the landowners pay self-employment taxes on the crop rent?
This is where the landowner needs to contact and work closely with their tax preparer or accountant. I do not believe landowners and share leases are always considered a material participant in the business. Since they are not always material participants, they don't necessarily have to pay self-employment tax on their income, net income.
Okay, well, let's all look at this next video on how share lease arrangements are calculated and how this information can be used for negotiating a share lease.
A crop share lease is one where the landowner and the tenant split the crop produced in proportion to their share of contributed expenses. Determining the particular split of crop yield and of some expenses follows a simple process. But that process may be complicated by local custom. The landowner contributes the land. The tenant is fully responsible for some expenses, such as labor and equipment. Several, but not necessarily all, other input expenses are split between the property owner and tenant. Any input expense can be shared between property owner and tenant. Yield increasing input costs should be shared between both the landowner and tenant. But as with any lease, nothing is set in stone. Everything is negotiable. Sharing yield-increasing inputs leads to better decisions on the quality and quantity of input to apply. If one person pays the total expense of a yield-increasing input, they may put less on than is optimal. If the expense is shared, they're more likely to put on the optimal amount. Fertilizer and pesticides are commonly considered yield-increasing inputs that are split by both parties of a share lease. Some landowners consider seed to be the responsibility of the tenant. Other landowners will share seed expense. Determining which inputs each party will fully provide and which inputs will be jointly paid is critical when negotiating share leases. Clarifying what each party contributes fosters a long-term, mutually satisfying leasing relationship. Cost of production budgets provide a great framework for discussing which inputs are contributed by one party and which inputs will be shared. Both landowner and tenant can mark which inputs they will exclusively contribute and which they expect the other to fully provide. All other inputs are then negotiated. Some expenses may be assigned to one party. Other remaining expenses may be split between the two parties. Fully understanding what each line of the cost of production budget means is also important. For example, the landowner might expect the tenant to do all field activities with his owned equipment. The tenant may not have a spray rig and needs to hire someone to spray weeds. Their lease agreement needs to specify whether the custom spray expense is paid fully by the tenant or is split with the landowner. From the cost of production budget, expenses can be transferred to a worksheet to help determine the share of output received by each. The landowner's contribution of land is added to the worksheet. The tenant's contribution of equipment, labor, and various inputs is then transferred to the worksheet. Value of tenant management can also be recognized as a contribution. In this example, the landowner provides only the land valued at $182 per acre. The tenant contributes $377 per acre of inputs. total contributions are $559 per acre. By dividing everyone's contribution by the total contribution in this example, it is discovered the landowner contributes 33% and the tenant 67%. This 1/3 to 2/3 ratio is then used to determine what each party receives from the crop and what each party pays for the inputs to be shared between the two. All inputs not solely contributed by one party, such as fertilizer, insecticide, custom fieldwork, and interest in this example, are proportionately split between the landowner and the tenant. 33% paid by the landowner, 67% paid by the tenant. Not every share agreement is 1/3, 2/3. This split is very common in southern Missouri. But central and northern Missouri have more 50-50 share agreements than 1/3, 2/3 share agreements. Other share agreements include 25-75, 30-70, and 40-60 splits. Local customs may affect the share. For example, corn may have a 1/3, 2/3 share, while soybeans grown on the same land may be split 40% landowner, 60% tenant. The share should be based on the relative contribution of each party. Crop share leasing offers definite benefits to both the tenant and the landowner. It requires communication and trust between each party. Writing down the agreement so each party remembers what was discussed and agreed upon helps prevent misunderstandings.
All right. So a big part of our program is to answer your individual questions. And I see we have one in the chat box now. Please keep them coming, and David will get to those at the end. I wanted to ask about this. The video mentioned that county and regional customs will influence rental arrangements, David, and how the variable inputs are split. Can you give us some more perspective on that?
Yes, I can. Rental agreements can vary based on local customs. They can vary from the region of the state. I've noticed from north to south, east to west. It can vary from county to county. I've seen variation even within the county. Now, many times this is based on the crop and the landowners. I found that landowners who have several farms, have several tenants, may have a set rental agreement they prefer to use. Many times, the share agreements that are based on local customs have their history based on the cost associated in the production of the crop. Corn and wheat can be from 50-50 to 1/3, 2/3, and sometimes soybeans are shared 40-60. Cotton has historically been shared 25-75 or 30-70. The reason for this is the high fixed cost of the specialized equipment in the production and harvesting of the cotton crop. Today's cotton pickers can cost over $1 million, and it can only be used for one thing, and that's to pick cotton. Therefore, those fixed costs cannot be allocated over other crops such as corn, soybeans, wheat, as you can do with a combine. Because of the high fixed cost and variable cost in cotton production, cotton farmers have told me that extra 3% they receive in a 30-70 shares crop, a crop share rent, versus a 33-67 crop share rent can be the difference between a profit or loss in many years.
A principle of share agreements is that yield increasing inputs be shared. So earlier you talked about fertilizer almost always being shared. Fertilizer, of course, a yield increasing input. What are some other yield increasing inputs?
Because of technology, more of our seeds have insect and other pest resistance. This makes seed cost a point of negotiation in the rental agreement. With more of our weeds becoming herbicide resistant, the sharing of herbicide costs may also become a negotiating point in the future. The use of cover crops is being used more and more by farmers. Research has shown that cover crops can help in weed suppression and control. This makes cover crops a potential negotiating point in a lease.
So it looks like share agreements are more complicated and rely upon what the landowner and tenant expect the cost of production to be. Are there any tools that can be used to help determine crop share agreements?
Yes, I have a spreadsheet which I've loaded on the class Canvas site that is entitled Southeast Missouri Crop Budgets and Rental Analysis. It gets the net returns over the variable and total costs for both the tenant and the landowner based on different crop share rental agreements, changes in prices, and also yields. Also loaded on that Canvas site are the aglease101.org guides and rental forms for sharing leasing. And you can always contact your county extension office, ask for the contact information for your regional ag business specialist.
Great, great information. We have reached the portion of our program to take your questions, and David will answer them. The first one out of the gate. How do landowners and tenants in a shared lease handle a government program such as an EQIP contract for planting cover crops?
You know, I think it said in the video that in a crop share agreement, they also split the FSA type payments. I'm not sure about EQIP. There's a lot of different rules on that. It might be, but I would probably say contact your local NRCS office, contact them, see what they have to say. Because many of those type of questions that I get in the office, since they're sort of the government agency on that, just ask them and they can be able to tell you that, answer that question.
All right, very good. Well, I have a question. How should lime costs be handled?
You know, lime is a very important yield enhancing input. And I believe it should be split in most cases between the tenant and the landowner. You know, I recommend that taking soil tests should be written into the lease agreement, and that the soil test should be taken every 3 to 4 years and results shared with both the tenant and the landowner. Having the soil pH at a proper level makes the other fertilizer inputs more readily available to produce higher yields. The issue with lime, however, has the potential of being a very expensive input, especially if you're going to need to apply 3 to 4 tons per acre, and that cost could be over $100 per acre in any given year. Also, as an input, you do not have to apply it annually like nitrogen, and so the soil gets a benefit over several years. Now, for the tenant who pays part of that lime cost, he may want to make sure he be reimbursed for some of those unused lime benefits if the landowner changes tenant at the end of the lease. This is why it's important to have a written lease that spells out how will the tenant get reimbursed or prorated on a prorated basis if the lease is not renewed.
Wow, complicated answer, but very, very helpful. I want to remind you folks, this is your chance to ask questions of our ag business specialist from Southeast Missouri, David Reinbott. David, how are fixed and variable irrigation costs shared?
Yes, I would say in general, they should be shared like any other farm asset and variable input. The cost of the center pivot should be shared in proportion to the lease agreement between the landowner and the tenant. And in many cases, the landowner will be expected to pay the cost of the well, the turbine pump, since they are both considered permanent fixtures to the land. Now, the irrigation motor to pump the irrigation water, the fuel tanks are usually paid by the tenant. Irrigation fuel costs, repairs for the center pivot should be paid in proportion to the crop share agreement.
Okay, we got a couple more questions. Your statement on fixed machinery costs was interesting. How can a tenant calculate his or her contribution in equipment costs? What factors would affect the equipment costs he or she contributes?
You know, we go back to the old, I started extension 39 years ago, the dirty 5, depreciation, interest, repairs, taxes, insurance. Each of those has a factor. Any asset, you go through those 5. Again, contact your local farm business specialist. They'll be glad to sit down with you, go through those numbers, and they'll give you some idea of what that fixed cost per year would be or acre, however you want to calculate it.
Here's a follow-up to the lime question and answer. Is your recommendation for how to handle lime costs different if the lease is a fixed cash lease?
Yes, I think a lot of times that go back to the lime, it sometimes is another negotiating point. I found that sometimes that a tenant will take over a farm, maybe the previous tenant didn't keep the fertility up, so there maybe need that. Remember I mentioned 3 to 4 tons of lime. So what I found that sometimes I recommended maybe for the landowner, I'll tell you what you do, go ahead and maybe you apply the first 2 tons, and then you two will maybe split the next 2 tons and get up to a certain level. And then you can go from the rent from there as a fixed rent. Again, that's sort of a negotiating point, because again, if you don't have your lime or pH to a certain level, you're never going to get the maximum economic yields out there, and your inputs will never make maximum for you. So again, that's one negotiating point. But again, you got to get that lime pH to the satisfactory level. And again, if you're not sure, negotiate it, but if it's very, very low, I would recommend at least the landowner bring it up to a satisfactory level.
All right. All right, here's another question. Have you had any experience with a farmer who switched from cash to crop share leases, and how should that conversation be started?
You know, I got that question this morning.
There you go.
And I said, the first thing you need to do is just sit down and talk with your tenant, your landlord, and ask. And one of the questions asked is, why do you want to switch farm? What are the purpose you want to switch? There's a lot of different reasons why. As I always tell people, a good tenant will make a landlord money because they're going to use them. They're going to try to use those inputs effectively, efficiently. They're going to use good marketing. They're going to do everything they can to maximize that income. And if you're getting a share of that payment, you're going to get a maximum too. So I find that the main thing is a lot of times when I hear people sometimes don't want to switch one way or the other, a lot of times it's just communication. But also I think sometimes people get to the point where they're saying, you know, I just want a certain amount of income. I don't want to pay any of those variable costs anymore. I don't like getting that bill from the co-op. I just want some income. And a lot of times the tenant said, that's fine. I'll be glad to work with you on that.
All right, here's another one. I'm a landowner who wants to learn more about green marketing and be a better partner with my farmer. Where can I go to learn more and become a more savvy marketer?
You know, there's several excellent marketing guide sheets that can be accessed and downloaded from the Ag Business Policy website. We've got a lot of good web guide sheets. Many of them are only 1 or 2 years old, brand new, been reviewed. So I would go to the Ag Business Policy website, go to publications, go through that list, find those marketing guide sheets, read them, download them. And after you review these guide sheets, I recommend contact your ag business specialist in your region, sit down with him or her, and she'll be glad to discuss them with you more and how you can be a better marketer.
Okay, here's an interesting question. How should partners and share lease agreements handle carbon credit programs? And is there a way to split the dividends fairly?
You know, I am not that up on those carbon credits. That's a new one out there. I'll just say I don't know that much about them right now. I'm going to say if you're in a crop share rent, probably percentage wise, it's 1/3, 2/3, 50-50. I'm sure they're going to have to be divided some way like that. Again, there may even be a guide sheet on that. I'm not 100% sure. If you have a question, contact your ag business specialist. We'll probably have to contact somebody like a Ray Massey, somebody like that on campus, and they could probably help us more on that one.
Right, and as we've done on some previous seminars, we've fleshed out those answers and put them up on the Canvas site for folks. So
Okay,
this is
good.
one, yeah.
Yeah.
And here's another one. Where are some good resources to get these share fixed leases written up for beginning farmers?
Now, I think I mentioned earlier the ag.
Oh,
Find it.
101?
Yeah, 101 there. Yeah, aglease101.org. Those are some excellent guides up there, and I would take advantage of those. There's some good rental forms there, and I would check those out. Also, again, I'll say it again, contact your local ag business specialist. I know I get contacted quite often about that. I'll go over them with the folks and make some suggestions on what they may want to look at specifically if they're a row cropper or livestock. You know, some of those type of things. But that's a very good website to go to look at some ag guides and rental forms.
Yes, and everyone on this program, I don't know if you can see it, but yes, it's in the chat box, the direct link to aglease101.org. Well, David, thank you so much. And thanks to all of you for joining us. I know there are going to be more questions, you know, the questions come after the program is over. So what is the best way to get in touch with you? Your email and phone number, which by the way, we will also have in the chat, I believe. Sure.
My email, of course, is reinbott@umsystem.edu. Or you can call me on my office phone. It's 573-545-3516.
All right. Well, thanks for spending your evening with us, David, and all of you who have joined us this evening. I'll be back in a week from tonight with Dr. Ray Massey. and postdoctoral research fellow Rohan Say to talk about flexing rent and a lot more. Have a good evening.